So if you're a freelancer with your own limited company and you're not caught by I-35, what we would do initially is have a discussion, see if you've got any other sources of income other than through your limited company, and take that into account. But normally we would then set you up with a small salary. For the current year, for 17-18, that would be just over 8,000, which means you wouldn't actually pay any pay-as-you-earn tax or national insurance on that amount, but your company still saves corporation tax. Over and above that, it would be more efficient to take dividends from the company. We can possibly look at splitting the dividends as well. So if you're married typically with a partner or spouse, we can look at making them a shareholder in your company, and that enables the dividends to be split between the two of you based on the percentage of the shares that we allocate to each of you. In terms of the tax you pay on dividends, each shareholder for the current year, for 17-18, can receive the first £5,000 of dividends without incurring any tax. That amount is reducing to £2,000 for 18-19. So the first £5,000 currently is tax-free. Above that, you'll pay tax initially at 7.5% until your total taxable income for the year reaches the higher rate limit, which is currently £45,000. If your total earnings go above that, then any dividends above that will be taxed at the higher rate, which is 32.5%, as opposed to the 7.5%. So there's quite a big jump. And if you can afford to, and you can just simply leave some of the money in the company so that you keep your earnings below that 45,000 limit. But if you need to take the money out, you'll take the hit for it. But at least we might have been able to split the shares and the dividends so that you're making the most of paying tax at the lower rate first. So those are the main things that we would look at doing. Small salary, rest as dividends and splitting them if we can, and then if possible keep below the higher rate tax threshold.